A stock split is an action a company takes to reduce the value of its shares and increase the number of shares outstanding. Companies do this to make their shares more accessible, increase liquidity, and attract a broader range of buyers and sellers. A stock split does not affect a company's fundamental indicators, but it can raise interest in the asset. The number of shares outstanding increases, while the price of each share decreases in proportion to the ratio. Investors do not have to participate in the process. All calculations are performed automatically throughout the broker. The main purpose of a split is to enhance the accessibility of an asset and boost its liquidity. Stock splits can take various forms depending on the company's goal and market conditions. The most common type is a forward split, where the number of outstanding shares increases and the share price decreases proportionally. Less frequently, companies may carry out a reverse split, which reduces the number of shares while increasing the share price. Forward stock split. In a forward stock split, the company increases the total number of shares outstanding and reduces the share price in the same proportion. Common splits include 2-to-1, 3-to-1, and 4-to-1 ratios, allowing shareholders to receive 2, 3, or 4 times as many shares respectively. The main goal is to enhance accessibility of assets to retail investors. A reverse split is a company reduces the number of its shares outstanding and proportionally increases the price per share. A reverse split is mostly used when stocks fall to a critically low price. This move lets company meet the minimum requirements for a stock exchange and avoid being delisted. Companies use different stock split ratios depending on their objectives, current share price, and the situation in stock market. The choice of ratio reflects the company's strategy and may influence how shareholders perceive the company. A well-chosen stock split ratio can attract new investors and boost the liquidity of an asset. Firstly, shares priced lower reduce the initial capital barrier for small investors. Secondly, a higher share count after a split boosts liquidity, making it easier to buy and sell securities. Thirdly, a company may conduct a stock split to keep investors interested. In contrast, a reverse split can be a smart move to help a company to stay listed on a major exchange. On exchanges like Nasdaq, a share needs to trade about $1. Tesla performed 2 stock splits, a 5-for-1 split in 2020 and a 3-for-1 split in 2022. The initial split took place when the share price surpassed $2,000, while the subsequent split was implemented following an increase in the company's market capitalization. As these examples show, companies use stock splits as a strategic tool rather than a purely technical move. A stock split may seem like a technical adjustment, but does not affect a company's fundamentals. However, its consequences for investors, mutual funds, and existing shareholders can be quite significant. After a stock split, the shareholders' ownership interest remains the same. Many investors, especially beginners, may feel uneasy when they see change in their shares holdings. The broker automatically recalculates the number of shares and their normal value, so shareholders don't need to take any action. A stock split has no impact on shareholders' rights, including voting privileges, dividends, or participation in shareholders' meetings. After a stock split, the total value of investors' portfolio will remain as it was. Nevertheless, stock splits offer great flexibility for investors. When share prices are high, it can be difficult to sell just a portion of a position, as shares often need to be sold in whole units or larger blocks. A stock split process involves several formal stages, each of which is essential for the correct accounting of securities and understanding their movement in the stock market between the announcement and the actual recalculation of shares. The announcement date is a moment when a company's board directs officially decides to split its shares and publish a corresponding announcement. This date is of great importance to investors, as the share price may change immediately after the announcement. Details about the split, including the ratio and anticipated implementation date, are typically shared in a press release or corporate statement. A record day is the day when a company compiles official list of shareholders eligible to receive more shares after the split. All investors who hold securities on this date automatically participate in the split, regardless of whether they purchase the shares long before the announcement or shortly before the record date. This key moment in the split process also affects how mutual funds and fractional shares are adjusted. The broker uses this date as a reference point for recalculating positions in the portfolio. You need to buy shares for the split in advance, no later than the ex-dividend date. The ex-dividend date, also known as a cut-off date, marks the point after which shareholders are no longer eligible to participate in stock split. To qualify for a split, investors might purchase shares before this date. The distribution date is when the new shares from stock split are officially credited to investors' accounts. On this day, the number of shares and their price are automatically adjusted according to a split ratio. These changes are reflected on trading platforms in broker statements, with no action required from investors. The updated securities become available for trading at the post-split price, and the broker ensures that the portfolio positions are displayed correctly. This date marks the final step in the split process and confirms the new parameters of share ownership. So, a stock split does not affect a company's fundamental indicators. It may influence the future actions of investors and traders. In addition, stock splits are often associated with positive expectation and a company's growth, strengthening its market image. Despite their advantages, stock splits also come with certain drawbacks. Splits often lead to short-term price surges that are driven more by market sentiment than by actual improvements in the company's fundamentals. An increased number of shares can distort the perceived value of stocks, particularly for inexperienced investors, which may complicate portfolio analysis and risk management. In addition, the recalculation process may temporarily cause confusion in portfolios and trading platforms, as updated data is reflected. Reverse splits deserve special attention, as the market frequently interprets them as a signal of financial difficulties in the company. Moreover, stock splits often mislead technical analysis and traders. Brokers and exchanges sometimes neglect to update stock prices in trading terminals after a split, which can result in mistakes when analyzing price movements with technical indicators. A stock split can be used in investment or trading strategy. Buying shares before split is a popular strategy among investors who are counting on high trading volumes and a possible jump in share prices. Buying shares after a stock split can be attractive because the price drops, making an asset more affordable. This strategy can be effective when investing in companies with solid fundamentals and a positive track records of past stock splits, such as on Apple, Nvidia, Amazon, and other blue-chip stocks. However, it's essential to factor in the overall market environment. Investment decisions should not be made based solely on a split. I hope you find this video useful. Like this video, subscribe to the channel, and bye!